Hey everybody, welcome back. This week I have on Robert. Robert, how are you?
Good. How are you?
Doing good. Thanks for joining this podcast.
Yeah, good to be here.
I want to start off with kind of a broad topic, mainly talking about AI. We had the famous Centrini piece that was published, I guess, not this past weekend, but the previous weekend, and that stirred up markets a little bit and stirred up a number of different people. What do you think is going on from the perspective of AI? Like, is AI actually leading towards a decrease in prices, a decrease in employment? Maybe like starting at a high level, is it like a real uh thing to be worried about, or is it kind of just hype?
Yeah, so it's kind of interesting. I had been thinking about it for a couple months now, um, and the equity market appeared to be concerned. So, you had kind of conflicting moves going on in the equity market. For example, you had materials and industrials; those were actually performing quite well, outperforming the S&P 500. But then you also, which generally that's kind of an early cycle indicator. But then you also had late cycle indicators and kind of more defensive positioning, where utilities, healthcare, staples, consumer staples were all those were also outperforming. And those kind of don't generally happen at the same time. So I was kind of like trying to kick around what was going on. I would point to kind of early November as a turning point, at least in the equity market, where some kind of strange rotation under the surface started to really appear. And that's kind of when I started to really try to think about it. And I'm not an AI expert. I don't know, agentic AI and recursive learning on this. I don't know. Like I try to listen to the people that are experts there, but that's not my area of expertise. So take this with a grain of salt. But what I have seen in both the equity market, the bond market, as well as what's going on in kind of individual granular details. So you can look at the labor market and just look at U3, which is kind of the headline unemployment number that everyone will talk about, and probably not notice too much labor market stress. But I'm a nerd and I follow and read almost every single report in it in the entirety of the report, NFP, jolts, ADP. So what I've been noticing going back maybe 6 7 8 months is that particular sectors are especially weak. So you have like information, for example, that's kind of one category. The areas that you would expect are going to be weak due to AI. If AI was going to take a job, it'd probably be white collar information sort of job. That's where the labor market weakness has been, not overall. But in those particular areas. And then also, recent college graduates, the youth have seen, a much higher unemployment rate. And generally, I think we know by now, a lot of those entry level jobs have just not been available for young people. So I think in the labor market, you were starting to see kind of indications over the past 6 7 months. If you look at Challenger Grain Christmas, that's a private firm, and they put out a report kind of focusing on just layoffs and terminations and that sort of thing. And we have quite high level of layoffs right now. But if you look at what the firms are reporting in terms of the reason for the layoffs, AI is the second most cited. So, the firms are saying it. You are seeing indications in the equity market because, again, you don't have, consumer staples, utilities, healthcare, and industrials and materials. You don't have those outperforming the S&P 500, together. They're kind of conflicting. And so what they have in common is that they cannot be disintermediated by AI, right? So, of course, we know software is, really, really hardly hit, whether it be, Adobe, IBM, cybersecurity has also gotten very hit. So, in the equity market, I think we're already starting to see indications of kind of a deflationary impact from AI. And then also in the bond market, we've seen bond yields, pretty much across the curve, sharply lower. So I think that, no matter where you look, there are indications that is already here. If you look at individual components within PPI, for example, now overall PPI on Friday, a couple days ago, I think the 28th of February, it came in quite hot. But if you look at the individual components within that report, there's already deflation starting to appear. So, in again, areas that would be affected by AI. So, I think that's already here. I think that's not showing up in kind of the top line aggregate data, that everyone kind of focuses on. But I think if you look at the right, cohorts and kind of more granular sort of detail, I think that you're already starting to see the kind of deflationary impact there.
Yeah, and I think one of the the big news stories that a lot of people saw was Block, Jack Dorsey laying off 40 to 50% of the entire employee base. And I've seen, various counter arguments saying, well, if you look back at Block, starting post pandemic era, they grew from like 3,000 to 10,000, and now they're just kind of correcting their overhiring that they did, and Jack is just kind of blaming it on AI. What's your perspective on that? Is Jack just blaming it on AI, and he overhired effectively? It's a good scapegoat, or is it maybe a combination of both?
Yeah, probably both. If I had to guess, I'm not in his mind, but if I had to guess, probably a bit of both. I think that, we're gonna probably see more of those sort of mass layoffs. I mean, that's almost half of his company that he just laid off. I mean, 4,000 jobs is quite significant, and I think the more that we get other large companies with a similar kind of announcement, I think that it could really spook the equity market and cause a bid into bonds.
Mhm. Yeah, I definitely want to get into, Bitcoin and bonds later on. But also, I think maybe starting out, I noticed one of the components in PPI was like software publishing, and that was down, I think, like 3.8%, as I think you pointed out in your article or a tweet. How do you expect this to, continue over like the next 1 to 2 years? Like, do you expect these subcomponents to continue decreasing? Do you expect it to start to bleed into like the overall, headline number that everyone sees? Like, how do you see this kind of playing out?
Yeah, it could take longer than expected. It could also come quicker. I really have no idea. Personally, I'm kind of positioned for it to happen, within the next 10 months, but that's just a guess. I really have no idea. But yeah, I think, eventually with those individual components that you mentioned, software publishing being one of them, there were a few that I put in a thread on my profile on Twitter that people can take a look at. There it. I think that is going to start to gradually have a disinflationary impact, kind of in the more broad sense. Now, it's tough right now, given what's going on in the Middle East and what's going on with commodities. And so, the kind of disruption in shipping and that sort of thing. So, it's kind of hard because we also have this kind of competing, countervailing force, which is commodities. And probably oil right now is up another 8%. It probably goes even higher. So you're going to have an inflationary impact there, but then you're going to have a deflationary impact from the areas where AI can, technological advancements, as Jeff Booth often points out, where those can have an influence I think that we're going to see further deflation, for example, in things like software publishing. I think we'll see further deflation there. And I think that there will be a kind of broader disinflationary force. But, to what degree that is offset by commodities, I'm still trying to work out. The past couple days has been pretty chaotic.
Yeah, it really has. Another phrase that you've mentioned a lot, I guess recently, probably over the years. I can't remember when you started saying this, but the phrase "the silent depression." Can you maybe explain what that is and how you're thinking about it?
Yeah. So I first started talking about this back in, I think, like early 2024. Um, I was reading and, as I do, and found that the definition of depression was not actually what I thought. I thought a depression was, 10% GDP contraction. Unemployment had to go above 20%, something like that. But what I found was it's actually not the definition of depression. You're talking about a prolonged period of time where economic growth is below potential, and subdued. Now, Japan had what they call the lost decade. Or lost decades, plural, and that was a period of time where they had, off and on deflation. The economy was shrinking. They had, quite poor labor market conditions, very poor wage growth, and that went on for literally over a decade. And so, kind of started when I was looking into that in Japan, and I started to, was I don't know why I'm the only one that does this, but I don't like to look at the headline data. I mean, I look at it and I watch it, but GDP, for example, uh, big number gets bigger. Like the growth rate, of course, I track that, but like what I like to do is more relative charts, right? Like I GDP, 31 trillion. I would like to look at that relative to the average hourly wage. If GDP is going up at, I don't know, 3% each and every year, but wages, the average hourly wage is only growing at 2% or 1%, then what good is all the GDP, right? Things like that. So that's kind of the way that I generally look at things. For example, personal income. This is a pretty broad way to measure, personal income, and it includes, investment income, and it's fairly broad measure. But that same thing up and to the right, big number gets bigger. But I like to look at that relative to the M2 money supply, right? So if personal income is up, I don't know, 5% over the past couple years, but the money supply is up by 10%, well, yeah, we're earning more income, but as a share of the money supply, it's actually going down. Our purchasing power, yeah, in nominal dollar terms, personal income is going up, but in real purchasing power terms, it's going down. Again, what good is 5%, personal income growth if the money supply is growing at 20%? So things like that. And what I started to realize was there was a break. Now, you can point to different points in time where things really started to kind of break down. But, things like personal income as a share of the M2 money supply has been shrinking for 2 decades. So I'll share my screen here and we can go through a couple of them. Um, Here, for example, is personal income as a share of the M2 money supply. Going back to this chart goes back to 2000. This was kind of a peak that I noticed across a multitude of different indicators or metrics. Here we see personal income as a share of the M2 money supply in totality, right? The labor force has grown tremendously since 2000. So here we're just looking at total personal income. Well, as a share of the M2 money supply, it's actually fallen by 35% since 2000. Now, it wasn't always this way, as we'll see in another chart. Personal income was actually growing faster than the M2 money supply for a pretty prolonged period of time back in the 60s, 70s, 80s, 90s. So this is a new phenomenon that personal income is falling or trailing the growth in the M2 money supply. My alarm is for some reason going off here. So yeah, and then per capita, again, the average American doesn't care too much. A lot of talk right now about labor share of income. The average American doesn't care too much about what total wages in the US are doing. They care about their wage. So I understand why economists look at, labor share of income, the total amount of wages relative to GDP. But I think it's much more important to look at the individual American, because if you increase the labor supply, both high skill, low skill, and with different programs, if you do that, like both parties have done over the past couple decades, the it's going to drive down the wage for the average American. And sure enough, that's what we can see here. Personal income per capita is actually down by 50% just in the past 25 years. So, looking at things like that, I started to notice that it was not just personal income as a share of the M2 money supply. It was a number of different metrics. They were all declining for the past at least 25 years. A turning point that I found to be pretty notable was when China was admitted into the World Trade Organization in 2000. So the China shock, economists have written endlessly about the China shock, but that was a turning point that I started to notice across a number of different metrics. For example, here we can see labor force participation rate. So again, if the economy is very, very strong, you would expect the participation rate of Americans to be quite high. Everyone would want to, join in, with the economic strength. But if anything, it's been declining for 25 years. If you look at, again, real personal income, which is what we just looked at, that's been declining for 25 years. The real average hourly wage in gold terms has been declining for 25 years. I think it's actually down like 85% over the past 25 years. And the real S&P 500 return, right? So S&P relative to gold, that's been going down for 25 years, or rather the high was put in 2000, and we have not retested that high.
Yeah, it's a lot of interesting data points. I do have a question about the personal income as a share of US M2 money supply. Do you think that that will ever reverse and start growing again? Or is AI going to make it even worse and perhaps accelerate it in the wrong direction?
Yeah, so we know it can. I guess is that there's the glimmer of hope for this for the average American is we know it can. So for example, here I'll pull up the chart from 1981 up until 2000. Generally there were periods of time where it was declining, but generally it was trending higher. So we know it's possible. And I think that unfortunately a lot of these things will get worse with AI. The everyone probably knows the productivity relative to real average hourly wage, a chart where the average American is not benefiting from the productivity gains that we have seen. And I think that that's probably going to continue. We have, an ever smaller number of companies that are benefiting from this kind of AI productivity boom. And I think that, unfortunately, it'll probably get worse. We know, again, from history, the average American doesn't really benefit from, productivity gains. Generally, those go to the corporations and the people that hold the equity. Right. So we have the top 10% of income earners in America own about 92% of stocks, right? Equity exposure. So we know that it's, the corporate profit margins have been getting boosted due to globalization, due to immigration policy. Again, both high skill and low skill, and globalization has really boosted profit margins. We know that the benefits have been flowing to not the average American, but to those who hold the equity, right? And we know that the average American doesn't have much equity. In fact, if you take the median American, they have basically no equity exposure.
Yeah, that's quite terrifying, honestly. I guess I've heard people say this over time. It's like if the top 10% or top 1% have, 92% of US equity, the top 1% I saw like has half of all US equity. Is like the market effectively the economy at this point? Like if markets start to fall, like it's not the economy is now the market.
Yeah, yeah, this is hyper financialization. And it's, ultimately a direct result of the dollar being the reserve currency. We for many decades now kind of set up a system where we will offshore our good paying blue collar jobs. It's important to remember about 65% of Americans do not have a college degree. So those jobs that used to be, pretty well paying for those people for over half of America. We ship them to Asia and they'll make the stuff. We'll run a trade deficit. We'll buy the stuff, right? Send them dollars and they will reinvest the dollars back into our financial markets. Well, this is part of the reason that we see, things like this, capital grossly outperforming labor because not only has globalization kind of boosted this dynamic, but you also have immigration policy again, where labor supply here in America has been dramatically increasing, despite the fact that the birth rate here in America has been falling for a long time now.
Yeah, this chart that you had up right there is interesting. The great divide between capital and labor, and kind of like we talked about, like AI arguably has the potential to accelerate this even further. What do you like? Do you expect there to be like a policy response to this if this continues? Like, how do you see this kind of playing out? If everyone begins to lose their jobs and so on and so forth.
Yeah, I think they'll have to. The the blue collar workers that had their job, shipped to China, during the early 2000s, they were told to learn to code. I think that, the reaction from policymakers to a bunch of white collar, Americans losing their job will be much different. I think that, they kind of have a bit more political capital, that kind of middle to upper middle white collar worker. And I think that you will see things like UBI, for example. I think that we already have a proposed bill right now in the Senate. There are two related to AI. One of them, I forget the exact kind of breakdown of both of them. One of them has to do with if unemployment goes above 5.5 for 2 quarters, then it triggers a policy response. But then you also have what they call living stipend, which sounds a lot like UBI to me.
Yeah, like I've tried to think about this. If AI is as powerful as everyone expects, and if the intelligence is greater than a typical white collar employee, which I think over like the previous months I was skeptical of, and then playing around with Claude Code and Claude PowerPoint and all these other models, I'm like, these things are like really good. It's getting kind of like scary good, knowing that it's only going to improve from here and perhaps improve exponentially. I mean, is there another way out other than like the rise of socialism or UBI? Like, can you think of any other way that this is going to play out, or is that almost like an inevitable consequence of just the situation that we're in today?
Yeah. Um, It feels kind of inevitable. I think that, there is potentially a way out. I just think it's, very, very, very unlikely that we get that kind of response. But, there are ways, and I don't hear any politicians really, really talking about it in a serious manner. But there are ways to balance some of the issues that we have, started to see. For example, I mean, wealth inequality today in 2026 is worse than it was in the Gilded Age. Where wealth inequality was so bad that we named an entire era of American history after that period of time. Well, wealth inequality today is worse. Are there ways to address that? Absolutely. I think that they involve higher tax rate. So whether or not that's socialism, to certain folks, there are ways to address some of this, and I think also, the dollar, what we do with the dollar. If we enact Stephen Myron's plan, that he put out in November 2024, uh, I think that that would help. Whether or not we actually do that, I mean, we know that they're trying tariffs. The tariffs are a joke. They're nowhere near high enough to have the effect that they want. So there are ways. I just think that they would be very disruptive. They would cause a lot of pain. You mentioned before, the interlink independency of the real economy on the stock market. You can't really tolerate a prolonged decline in the stock market. I put out an article, I think like July 2024, where I said, why the U.S. government cannot afford for the stock market to decline. And it goes through the fact that, capital gains tax, for example, is one of the largest marginal drivers of overall revenue. Stock-based compensation. Once you start including, kind of all the second and third order effect, the wealth effect, for example, we know that part of the reason the U.S. economy has been held up recently is the top 10% that we've been talking about. They hold a bunch of equity, pretty much all the equity, and those equities are greatly inflated. So they feel wealthy and they go out and they spend. If the stock market starts to go down, that could go into reverse, and could be quite damaging to things like consumer spending, which is about 2/3 of U.S. GDP. So, are there ways to go about it? Yes. Would they end up causing, a bigger issue right down the road? That's really the issue, is that we've kind of boxed ourselves into a corner where we can't really get out of it without causing, pretty tremendous, disruption and pain. We've tried to defy financial gravity for decades now, and you can do that for, a period of time, but eventually financial gravity ends up catching up to you. And, we've been able to overconsume, right? The US runs a twin deficit. So by definition, in the aggregate, the US overconsumes by running a fiscal deficit and a current account deficit. That's been very good, by the way, for the top 1%, because again, the current account, the other side of that, the inverse on a accounting basis, is the capital and financial account. That has greatly boosted financial assets. So, and the net worth of the top 1%, kind of correspondingly. So, there are ways. I think that they would cause a tremendous amount of discomfort, especially for the elite. We saw, by the way, how. I mean, I subject myself to the torture of watching mainstream media just to try to get a read on kind of where that kind of middle, that I don't know how to describe it, but that blob, as Mike Benz calls it, kind of where they're at. And they were hysterical over tariffs. Well, you balance the current account, you reduce the amount of capital inflows into the financial assets that we know the top 1%, top 10% all own.
Yeah, that's definitely very interesting. Maybe we can start to get into the your outlook, I guess, on both Bitcoin and cash and bonds, and kind of how it ties into everything that we're talking about. So, like, maybe at a high level, how are you thinking about that?
Yeah, I really like Bitcoin. I'm very long Bitcoin. More than half of my net worth is in Bitcoin. But I've been getting pretty cautious here. I think that when you combine the issues that we talked about with AI, the deflationary impact there, when you combine that with what we see with private credit, starting to kind of those shock waves starting to appear, and then you add in, potential $120 barrel oil price, things could get kind of ugly before they get better. So my general kind of view right now is that, combination of AI, the deflationary impact from AI, private credit and the potential kind of, ripples there with private credit that we're already starting to see. You combine that with much, much, much higher commodity prices. Like a lot of people right now, today and yesterday, are talking about the inflationary impact from crude up, 15%, I think, since Friday. A lot of people are talking about the inflationary impact, but I'll remind everyone that going into '08, oil had gone up by like 150% over the past 2 years going into '08. So, the only cure for high prices is high prices, and eventually commodities will get so expensive that you'll get demand destruction. So, I think that, yeah, the initial read with commodities, I might have said that and people go, what? How does higher oil, how does 120 barrel oil, how is that deflationary? Well, it's deflationary, a couple months later, because, Americans can't afford to put gas in their car or to, buy the item that is trucked, using diesel. It goes into everything. And so eventually inflation, or the inflationary impact from AI, excuse me, from the war. There's so many things going on right now. The inflationary impact there, yeah, initially, right, for a month, 2 months, we might get kind of an inflationary impact, but that will then transit to deflation as demand destruction kind of takes hold. So I think that, over maybe the next 12 months, we see kind of, again, there will be volatility in there. But I think that generally, within the next 12 months, we'll probably see a deflationary impulse. And I think that that will be very, very disruptive to the U.S. government, to the average household. There will very quickly be pain. And I put out an article, I think the summer 2024, why the US can't afford a recession. And in that article, I talked about the math of a recession. By definition, in a recession, your revenue goes down. And I found that on average, it goes down about 22% in a kind of garden variety recession because people are losing their jobs. So, income tax, that revenue component is going down. You have financial assets going down. So, cap gains, right, can hopefully understand why revenue goes down. But not only that, that would be bad enough for the government. Not only that, but expenditures go up. So, automatic stabilizers, those sorts of things cause expenditures to go up. So you actually get a widening of the deficit or a worsening of the deficit. And what I found was, on average, over the past couple recessions, you have about 7 to 9% increase in the deficit as a share of GDP. That would take, because we have such a large deficit already, that would take our deficit to 15%. That's unsustainable. That is, if you think about it, if you remove the foreign purchase of U.S. Treasuries, which is, I understand, a large caveat, but just for perspective, if you remove that, 15% of the economic output of the US economy would have to go to buying US Treasury debt each and every year just to keep the lights on, right? Just to keep the wheels on the bus. It would take 15% of your total economic output. So yeah, that is a very, very large deficit. In nominal terms, it would probably go to about 5 trillion. Um, which is just crazy to even say, but that's what the math shows. And I think that, the Fed will have to come in. They'll have to monetize that, whether it be called QE, whether it be called, some fancy, acronym. They'll have to come in and provide support and be a buyer for, a lot of that debt, most likely. You'll also have private credit, which again, in a recession would, in a deflationary environment, private credit, heavily weighted, by the way, to software. About 40% of a lot of this private credit is software companies. So, you'll have to backstop private credit. From what I found, if you look at cross collateralization, right, not just the kind of not just individually how much private credit, how much that exposure is, but if you look at like the kind of ripple effects that could be caused, you're looking at about 3 to 5 trillion. So the Fed will have to come in, backstop that. You'll also have, potentially, if the AI disruption is a driver of this kind of deflationary shock, you'll have UBI that the Fed will have to, come in and provide support. You'll also have, issues in the $10 trillion mortgage market. I think it's actually like 13 trillion. You'll have issues there, right? This is a large amount of money. I mean, we're talking 20 trillion if you add all that up. And so, yeah, I think the Fed will have to print an ungodly amount of money. And, in that environment, Bitcoin is what you want, in my opinion, to own. Now, could Bitcoin go to um, four-digit number before that? Yeah, I think so. But if you're able to look through that initial impulse down and that initial deflation, I think that Bitcoin is, I look, given my view, I did not sell my Bitcoin. I'm a bit hedged with, TLT calls, but, I didn't sell, I personally don't want to be unexposed, right? I don't want to have no protection against, money printing, and debasement. So, we know Bitcoin, has kinda not performed well, going back to late October. Again, that turning point I mentioned earlier, that was when a lot of the kinda high beta corners started to underperform. That was also when you saw, kind of the moves I mentioned with consumer staples, utilities. Some of that kind of started late October. The rotation started late October. Just so happens, that's when Bitcoin topped. Also, we had bank reserves start to decline. Then, we had issues in the repo market, liquidity issues, Q2, Q3, Q4 of last year. So that was kind of trickling into Bitcoin. So we know Bitcoin's not, been performing too well. But I think that unfortunately there might be more downside. I'm not shorting it. I'm not trying to make a call definitively, but I am prepared for Bitcoin to go much lower before it inevitably goes much, much, much higher. People talk about like a $500,000 Bitcoin or $1 million Bitcoin, 2 million. That's how you get it, right? A recession arguably acts as a margin call on the US government. And, we know they're not going to let everything fail. They're going to print the money. And Lawrence Lepard and the big print, that whole kind of thing. I think we're not there yet, but arguably deflation is probably the most bullish thing for Bitcoin as long as you're not levered, have no leverage and have a long time horizon, low time preference. A deflationary shock is arguably the most bullish thing for Bitcoin.
Yeah, I generally agree with everything that you just said there, and I do think that like when people talk about this concept of like deflation, and is it good for Bitcoin, is it bad for Bitcoin? It's like most of the argument is probably just thinking about your time preference, right? Like if this does play out over the next 6 to 12 months, yeah, Bitcoin and the S&P falls significantly, it's completely logical for Bitcoin to fall significantly as well. But if you can zoom out and you can avoid a margin call or whatever else, just being in a bad position with your personal balance sheet or your income statement or whatnot, then arguably, it could be an incredible opportunity to be buying Bitcoin here. I guess like my thought that I want to get your thoughts on is like at what point does the quote unquote big print like occur? Is it a certain S&P drawdown? That credit spreads blowing out? Is it something else? Is it like an unemployment rate that gets hit? And like how do you think about like when that would occur? Because I know you did mention 4-digit Bitcoin. You know, anything is possible. I mean, it could tick down there for, of course, and I agree. Like that's one of the reasons why you shouldn't be leveraged long Bitcoin with a margin call. It's a very bad idea. But like what would be required maybe to get Bitcoin down to that level? And like, at what point does the policymakers respond to correct all of this?
I'm not sure. I think what I've been calling for, in terms of prediction, going back to late 2024, what I said for 2025, and I said it again, kind of my prediction for 2026. I said just expect higher volatility. And I think that that is probably going to be the dominant theme over the next 9 months into the end of 2026. So I think there will be a lot of volatility, both economically, both financially, right, markets, but also socially and politically, unfortunately. So, trying to, trade the chaos. Again, I have some, kind of trade on what TLT calls, but generally trying to time it, I don't think, is probably going to be very easy. I think that there's going to be a lot of volatility. I think that policymakers will come in kind of at the drop of a hat, right? You'll just wake up one morning and, if the S&P 500 is down 10% over the past week, you could wake up and it's right back up. It's up 10%, like those sort of in that sort of environment where you're getting tremendous volatility, I think is what everyone should expect for the next 9 months. I'm not sure, if there is a level. I think with AI, if you look at unemployment right now, U3 is pretty, low historically. But U3 maybe above 5.5, probably, or 6. I think that could be, kind of a indication that things are starting to really get a bad in the labor market. And I think that the rate of change of unemployment, right? If we get a dramatically higher print kind of out of nowhere, if initial claims start to kind of unexpectedly rip higher, that sort of thing. I think it's not only the level, but also the rate of change. And so, I think that again, that goes into volatility. I think that we're going to see larger moves. They will be quicker. More velocity. And I think that the policymakers will have to be much quicker on their feet. Now, that might be putting too much faith in them. They have not proven to be the most uh, proficient at responding to economic crises. But I think that with Scott Bessent and Stephen Myron on the Fed, some of these people are quite intelligent. When it comes to markets, when it comes to economics, macro. So I think that there is a potential that they are quicker than what we have seen, historically. But I think trying to time it or watch for a certain level, we have so many kind of conflicting or disparate forces right now. We have the AI issue, we have geopolitical issue right now, in the war. But then we also have, kind of the potential financial private credit sort of issue as well, right? And we're already seeing credit spreads start to widen a bit. You'd mentioned that. I think that could be an indication of issues with private credit. But I think it's all kind of interlinked. I mean, again, to the AI theme, you have, a lot of these private credit firms are 40% of their book. Half basically is software companies. So, that is very much interlinked, private credit and the AI story. But, for private credit, if you get credit spreads blowing out, I think that that could be another indication for sure of issues in the kind of financial sector, which, as we talked about earlier, given the hyper financialization of the US economy due to the reserve currency status of the dollar, that hyper financialization dictates, that if you do get issues in our kind of financial sector, that those very quickly become economic issues in the broader economy.
A metric that parts of the Bitcoin community has been talking about a lot recently, um, is ISM PMI. I'm curious, like, if you agree or disagree with kind of how the community is viewing it, because like if you look at it right now, the metric is like forecasting that we're in a potentially like economic expansion zone, and like we've kind of been in this, I don't know, silent recession, for the last few years since like 2021 or so. Or is there any like credibility with that, and like the fact that like maybe markets are actually about to start doing quite well, especially Bitcoin? Or is that like, just a coincidence, maybe a backward looking metric that, uh, and this AI deflation and commodity and rising oil prices, will that like override any sort of like, potential forward looking ISM PMI metric?
I think so. I think PMIs are, pretty good. I watch them very closely, but I think that we definitely have some indications of early cycle behavior in the economy. I look again to what we were talking about earlier. Another thing I found helpful is not looking at, for example, job openings. A lot of people look at that from Jolts. I have found it kind of also helpful to look at the rate of change of job openings. And, when you look at rate of change of job openings or the M2 money supply or defaults, right, charge offs with credit cards, these sort of things, what you do see is a very characteristic, during a recession, job openings will go down, right? So rate of change will be negative. It'll get more and more negative. But then eventually, the everything kind of bottoms out, right? And the rate of change starts to go less negative. It's still negative, but it's going less negative, right? Back up to zero. And then eventually that rate of change goes positive. Well, I did a video that people can find if they're interested. 13 charts that show we just came out of a recession. And there are quite a number of indicators, not only in the labor market, but also with credit and all sorts of different metrics that I looked at, across different kind of areas of the economy. There were a number of indications that we were early cycle, right? That we had actually just came out of a recession over the past 3.5 years, maybe. And so, I could definitely be wrong. I could definitely be wrong. I think right now it's very uncertain. On Bloomberg, turn on Bloomberg TV, or CNBC, you'll have like back to back to back disagreements, right? Very intelligent people that made a lot of money, some of them, and they have wildly different view or interpretation, right? It's a very difficult time to try to make sense of and predict and that sort of thing. There are definitely indications that we are early cycle, and PMIs being one of them. That video I mentioned, there were 13 different metrics that I looked at where the rate of change bottomed out. And is just now starting to go positive again. Very indicative of kind of early cycle sort of economic conditions. So there are definitely indications, and that would be good for Bitcoin. That would be good for kind of broader economic growth, especially this kind of broadening out that we're kind of sort of seeing. It's kind of reversing a bit, but there are definitely indications of that. I kind of again think that the higher commodity prices, I think that the AI trend. Now, how much would that affect ISM PMIs for manufacturing? Right. That is kind of another question here. Manufacturing, if you look at like employment, for example, manufacturing employment is only, I think, 5% or so of the total U.S. economy. So, manufacturing pretty a small sector, in the broader economy. So, if manufacturing PMIs are ticking up, which they are, how much, number one, that's not really affected by AI. And number two, how much real impact are we going to have from that given the relative share of manufacturing? So, services makes up kind of the vast majority of the US economy.
How reflexive do you think markets are today? Like in the sense of, okay, lower market prices for assets, ultimately kind of leads into a deflationary spiral type event, and versus the other way where it's like, okay, well, higher market prices, whether it's Bitcoin or S&P or real estate or whatnot, means you have kind of like a stronger collateral base, which begets more lending and more economic activity. Like part of me feels like it's very fragile kind of in both directions. Would you agree with that? Or how do you think about, just um that overall?
Liquidity you're talking about? Like,
Yeah,
kind of
and just like
broader.
how like like I guess like also like related back to kind of what we're talking about. It's like what would it like, you said there's some early cycle things, ISM PMI like looks optimistic. Like at what point does the market just start going up enough to where it starts working out fine just because we got momentum going and everyone's borrowing and lending again, everyone's excited. Like is yeah, like which way could it go and what are the odds that it can just get the engine can get moving again and we're off to the races without this like deflationary crunch.
Yeah. So again, M2 is something a lot of Bitcoiners will watch. A lot of people look at it the wrong way, though. They're looking at just kind of the absolute level of M2. And look, that's pretty much always going to go up and to the right. What I think is much more instructive is to look at the rate of change of M2. And when you do that, what you notice is in Q2 of last year in 2025, M2 growth, the rate of change of the M2 money supply, that rate of change started to do the opposite of what I was talking about earlier, started to top out. And actually head lower. Right now, the 6 month rate of change of M2 is only 1.4%. So that's quite low, in kind of the historical context. And the yield curve has been flattening, so that makes sense, right? The financial sector, the banks, they like to borrow short, lend long. They like a steeper curve. Well, the curve has been doing the opposite, so you get less lending behavior. And yeah, I think it's kind of already started. Look, if the Fed came out and increased the RMPs to 150 $200 billion a month, maybe you could offset the kind of softening. But I think that kind of on the current trajectory, everything that I'm looking at is not indicating that. If anything, it's kind of indicating that we might already kind of be, well into the kind of softening phase where everything starts to kind of top out, right, and head lower. So M2 growth, again, I would highly recommend people watch. I see a lot of M2 charts being posted in Bitcoin Twitter, but they're, in my opinion, looking at it the wrong way. I think it's really important to watch liquidity, and I do, but you have to look at it the right way. And I think that once you look at M2, for example, the rate of change of M2, that is pretty anemic, and that is concerning for the kind of heating up, I guess, that you're describing.
Yeah, that makes a lot of sense. Maybe last topic, just kind of covering the societal consequences of all of this. I know you've noted that like the deaths of despair is like rising in a multiple of actually Great Depression levels, which is kind of very sad and disappointing. But like, how do you see this playing out over the next few years in terms of like the societal consequences of what we're talking about?
Yeah. Um, So for those that, probably are not familiar, this particular metric, what it's doing is tracking suicide, alcohol related, and drug related, overdose deaths and combining it into one. And the technical term is actually economic death of despair. And, people can read more about that. There's been a lot of research done on this particular metric. What we see here, this chart goes back to the 1900s. It is a rate, right? So it's not the total amount. It is the number of people per 100,000, right? So it adjusts for population. And what we see is deaths of despair are 3 times what they were during the Great Depression here in the 1930s. This, like, I don't hear anyone talking about this. I've been trying to like scream about this, from the rooftops. But there are indications that America and the people, Americans, are not okay. And this is just one. The silent depression goes through a number. of course. But this is just one. But I think that, these sort of metrics, what we saw after the China shock, going back to kind of the deflationary impact, I would recommend folks, read my article that I have pinned. I spent a lot of time on that. One of the components of that article was comparing the deflationary impact that we might get from AI that is going to affect white collar workers, right? Comparing that to kind of when was the last analog? What can we compare this to? What can we expect? And the last real deflationary or disinflationary sort of high productivity environment was the China shock. Again, kind of that period of time in early 2000s where everything started to peak out and move lower for the average American. The China shock, what we saw from that was deaths of despair, for example, double. Over the next 20 years, deaths of despair doubled. And I go through a number of metrics in the article, but for example, if you're in one of the Rust Belt towns, it's not uncommon that 40-50% of the working age men are unemployed and just dropped out of the labor force, and about 40-50% are taking drugs. So it's not pretty, right? When you get a dislocation and a disruption from a productivity boom, it is not very good for the average American. It's quite poor, actually, especially when all the benefits of that productivity boom are flowing to the top 1%, to corporations. It just kind of makes it even worse, pouring salt in the wound. And so, yeah, I think that, we know what to expect. We saw it with the China shock. And I think we're going to see it again, unfortunately. This time, however, it won't be the blue collar workers that are disrupted. It'll be the white collar workers. If anything, blue collar workers might get a boom here. If you're in the trades, if you're an electrician or a plumber or HVAC, worker, you might actually finally start to get a benefit. Yeah, if you're a white collar worker, I think that we're going to see a repeat of what we saw during the China shock. And also, I'd point to, for example, antidepressant prescriptions; those are up like 300% since 2000. Americans are, if you know where to look. And are able to understand, second, third order effect. If you know where to look, there are many, many, many indications of exactly kind of how healthy the average American or American society is. And I would argue it's quite unhealthy. It's probably going to get worse. I think another thing we'll see is you had mentioned. Kind of a left wing economic model as being kind of inevitable. I think that is true. I think maybe the current administration might have had a shot, right, to try to show to try to enact some more. I don't want to say free market because they're they're taking equity stakes in public companies and doing all sorts of stuff that is not free market, but more less kind of communistic, socialistic, right? And I don't really see them doing well in that regard. Public approval of their administration is quite poor. I think this Middle East war is just going to make it worse. And again, looking at kind of the economic metrics, labor share of income just hit a new all-time low, and that's not per capita. It's even worse once you adjust for population growth. So, Americans, like if you look at the University of Michigan Consumer Sentiment Survey, current economic conditions, that metric, which we have 50 plus years of data for this, is at an all-time low, lower than 2008, the GFC, lower than 2000. There are a multitude of metrics showing that not only kind of in the hard data, but also in the survey data, that Americans are not very happy, and it's not working. They're not doing very well to kind of show maybe an alternative way of going about things. And so, yeah, I think that the pendulum will probably swing, to the other direction. Mamdani was shocking to some of the kind of Beltway, blob establishment kind of types. Not surprising to me. I think people like that will do very well. I think that, President AOC, or I mean, people joke about that, but that sort of thing, I think is going to be the natural response. I think people, Americans, were willing to give, Trump and MAGA, they kind of said all the right things, and they were willing to give him a chance. But uh, I think that the patience and the tolerance to endure, years and years and years of, pain, I guess, before you get to a benefit. I don't think the American people have much tolerance, much patience, given, again, kind of silent depression stuff. This has been going on for 25 years, if not longer. Some of the metrics I look at go back even further than 2000. So I think the patience is wearing thin, and I think that the pendulum will swing into the other direction, into a President AOC sort of direction. And unfortunately, I think political volatility is kind of another thing that we should expect.
Yeah, it's definitely a sad situation on a number of different fronts. Maybe closing thoughts. Like, is there any way to end it on an optimistic note? Like, I do think that like sound money and Bitcoin can help ease a number of these problems. But I'm curious, like from your perspective, is there anything maybe to for the audience to look forward to over the next decade?
Yeah, I don't mean to be I've been called all sorts of, doomer and this and that. I don't mean to be that way. I'm just looking at the data, and coming to the conclusion that the data is telling me. I guess, I kind of mentioned it before, but we do have history where America was able to provide a better quality of life for its people. So here, for example, is kind of one of my favorite charts that I think kind of combines everything into one chart, a lot of the concepts. So here up top, we have kind of the real economy, or different ways to measure, kind of the real productive economy for the average American. We have labor force participation rate, right, which is a very kind of intuitive way to model, if the economy is working well, people are going to want to go work in it. GDP, for example, if that is increasing, again, big number gets bigger, that's great. But is it growing faster than the money supply? Personal income as a share of M2, and velocity of money, which has plummeted. If you look at those metrics, they were all going up from, I think this chart starts 1962 and goes up to 2000. All of those were trending in the right direction. What was trending down? So if kind of the real economy was growing, and gaining share of kind of the total pie, what was losing share? Well, government debt to GDP. Remember, this is a metric, a calculation, a division. So what we see here with government debt to GDP going down is GDP is growing faster than government debt. Um, Government debt to GDP, declined. Corporate profits, their share of kind of the total pie, went down. Uh, S&P 500 grew at a slower pace than the overall economy. If you look at S&P 500, relative to GDP, the Buffett indicator, that actually grew slower than the overall economy. Now, that is not what we've seen for the past 25 years. We saw a reversal. But my point, M0, M2, this is, the degree to which kind of what I call government money, base money, M0, is growing at a, what rate is the Fed printing bank reserves and currency, and versus, how much private lending is going on from the private banks. This is another huge component, by the way, of the silent depression stuff is, there's been a break when it comes to the old way that credit was created, the degree to which it was being created, and also who is creating it. Right, we can see that after '08, the government is the prime credit creation driver, not the private banks. And I would highly recommend people watch, follow Richard Warner. He's been great, written a lot of great papers on kind of private credit creation. But the point here being, there we do have history where corporate profits were declining, government debt was declining, financial assets were declining. Now they could go sideways, but if GDP is growing faster, this ratio will decline, and then M0 divided by M2, we have multi-decade period of time where those were trending downward, and the real economy was trending upward. So what it shows is that with the right policy, you can get a real economy. You can get an economy that benefits the average American, instead of what we see today, which is government debt is growing at a much faster rate than the overall economy. Corporate profits, by the way, their share of GDP has more than doubled over the past 25 years. S&P 500, right? Financial assets are just soaring. It used to take, back here in the 1960s, 1970s, it took about 15 to 20 hours of work at the average job to get one share of the S&P 500. Now that number has gone, from 15 or 20 back in the 70s to 200, over 200 actually today. So, we know financial markets grow much faster than kind of the real economy. That is kind of what we turned our economy into. But it doesn't have to be that way, and it is possible. I think you mentioned hard money. I think, of course, definitely agree on that. But I think that smart tax policy. I think the trade deficit and turning America, addressing the fiscal deficit as well, turning America from a country, or kind of in the aggregate, that overconsumes, back into one that is actually net productive, right? I think it's a simple concept, right, for Bitcoiners. If you are not producing more value than you're consuming, you can't accumulate Bitcoin, right? So turning America back into a country that is net productive, I think would be a huge benefit. Back here in the 60s and 70s, we did not run a 5% of GDP trade deficit, and fiscal deficit either. So I think that there are ways to address it, and it just takes policymakers that understand the real issue, and are able and willing and courageous enough to upset the elite, to enact those policies.
Yeah, that makes a lot of sense. I like what you said about becoming a net producer. I guess maybe the audience can go back, and everyone can start with themselves. If you go out there and produce more than you consume, then we're hopefully moving in the right direction. So, Robert, thanks for this great analysis. I enjoyed it a lot. Any final closing thoughts, or where the audience can go learn more about you and your work?
Yeah, so I have a YouTube channel, Infonomics, that people can check out, and yeah, my Twitter account. I post some charts also on Instagram, so I'm over there, kind of not focused over there as much, but yeah, Twitter and or X, at INFRAA underscore, and then yeah, on YouTube, Infonomics. I put out a lot of videos, so if people are interested in any of the topics kind of more in depth, they can check out YouTube, and yeah, that's about it.
Love it. Well, thanks again. This was great.
Yeah, thanks for having me on.